Um, Last time we were talking about stock investing basics, and I just introduced what stock investing is, what are the benefits, the change from being an employee to being an investor, and what advantages that gives you. And we introduced the idea of investing in the stock market. We went ahead and talked about how to go about doing that and what are the benefits you get from doing that. Among them being you can earn extra income, you can save and invest for future expenses. You can have a variety of things going for you in terms of passive income and the likes that will liberate you financially from the day-to-day 9 to 5 or 8 to 4 kind of work schedule. So that was a lucrative thing for a lot of people because you don't want to work all your life till you are you're 60 or 50 retirement age, and then from there on you have another 30 to 40 years of just looking at life go by. So you want to have some sort of retirement, you want to have some sort of things that fulfill you in your day-to-day life, and part of that involves you having some sort of income, some sort of wealth and savings that will take care of you, towards your end of life. So that was just part of the introduction, and today we are talking about the second part, which is how to go about investing in the stock market. And the number one question is, what do you need? So a lot of people think, you need all these things that big financial institutions have. You need to access market data that costs a lot of money. You need to have 7 or 10 screens that show different charts here and there. You need to have a team with you to start investing. Contrary to that opinion, you actually just need the basic thing, which is a smartphone. If you have a smartphone, you can invest in the stock market. But if you want to enhance your stock investing capacity, you'd rather have a laptop or a desktop that you can access, some of these platforms with. And in addition to that, I know our smartphone comes with these calculators, but I would recommend you have either a simple calculator or a scientific calculator. I know some of us have it from high school days, college days, or whatever. You could always have a calculator laying around. That's good because you'll use that calculator for calculating a few things like how many stocks do you need to buy with the amount of capital you have. And doing that math, generally speaking, you'll need a calculator. And having a separate calculator from your phone, if you're using your phone to trade, having a separate calculator will help you for you to do that math. Now, on top of that, you need good internet so that, when you're ready to place your trade, your internet doesn't disappear and then you're there hanging, wondering, am I going to miss the entry? Am I going to miss the exit? So you need a good internet. Typically, normal internet on your phone can work, but if you're using a laptop or a desktop, you need to have a little bit of good internet. So that's what you need. You don't need all that fancy stuff that you see out there that people show off. Several screens with I don't know how many people trying to trade at the same time. As an individual, you only need one device or two and you'll be good. Now, to get started after having all these things, one, like I said, you need a broker. So you should have opened an account. You should have deposited your money into the account. So your account is live and ready to go. That's the first thing you'll need to get started, because you can't start without an account, or you can't start without a way to invest. So whether it's a broker or a financial institution that invests on your behalf and gives you access to trading, you need that in the first place. And then if you're using your smartphone or your laptop or desktop, you need the trading platforms, which is the mobile apps for the brokers or the desktop apps for the brokers. So a broker like Interactive Brokers gives you an app where you can just log into the app and you can trade from the app directly, just like any other app. Easy to use, straightforward, if you know what you're doing. So that's one thing you'll need. And then because you'll be analyzing stocks and doing a few other things, you'll also need chatting sites like tradingview.com. You'll need news sites where it gives you news of what's happening in the stock market. You can look up what stock is, what's going on with a particular stock, what is stuff to do with the earnings and the likes. So you need a site like benzinga.com for that, or seekingalpha.com. With these sites, you can search a stock and then it gives you the news that is going on. And then you'll also need screening sites like Finviz. With Finviz, I've talked about Finviz before. Here is where you go and search for stocks that meet your criteria for either buying, or if you are trying to look for a stock, if you've already bought a stock and you're trying to see if it's good to sell, and it shows up on the screening. That is, you put in the criteria for selling or you put in the criteria for buying. You can use Finviz to do that. So on top of that, you'll also need earnings calendar sites. So there's if you just type earnings, stock earnings on your browser, it will give you a list of earnings websites. So some of these things are all in one app or one website. That is, if you're using TradingView, you can also use it to get the calendar, earnings calendar. You can use it to get the news. You can use it for screening. Benzinga is the same. You can do the same with that. You can screen with it. You can chat with it. You can do all that. So that's the sites and platforms that you'll need to get started. But now is when the game begins. You want to start trading. What do you do? First things first, you need to screen for stocks. By screening, I mean you want to sift out some of those stocks that do not do good and get the ones that do good enough for you to buy them and expect a return after a certain period of time. And screening involves you putting in a criteria, and some of those criteria include stuff like volume. Volume is how many shares are traded, how many shares of that stock are traded in a particular day. So my go-to number is around 500,000 shares of volume, which means it's trading around 500,000 shares on a particular day on average. And that means it's a stock that is active. It moves relatively fast, but not too fast. Something that has like 2 million shares in volume will move too fast because, there's a lot of that shares in the market and people are buying a lot of it and selling a lot of it. A lot of movements will happen. So if it's a cheap stock that is under $50 a share, but has 2 million and above volume, that means it's very volatile. But if it's an expensive share like Facebook and it has 2 million shares a day in volume, that's normal because Facebook does over 3 million shares a day. So depending on the type, the price and the type of stock you're buying, if it's large cap or blue chip, the volume will be a little bit higher. But for the most part, as a beginner, you're trading around $10 to maximum $50 a share. you want to trade something that is around 500K in volume. And that gives you a good stock that has a little bit of momentum, a little bit of volatility, a little bit of quicker returns than if you say you went and bought a stock that has less than 100K in volume. So when you're screening, volume becomes a very critical thing, which will determine how fast you make the money in the process. Now, another criteria I use is RSI. RSI stands for Relative Strength Index, and Relative Strength Index is an indicator we use in the stock market, where it just shows you how far the stock is from being overbought or oversold. And the idea of overbought and oversold is what is the outlook on the market for this stock? Are people more inclined to buy this stock, or are people more inclined to sell this stock? So when you use RSI, you'll discover if people are willing to buy this stock at this point, or are more inclined to buy that stock, or are more inclined to sell that stock. And therefore, if you're buying, you want to look for a stock that has a lot of people wanting to buy, as compared to going for a stock that a lot of people are selling. So you don't want to sell when people, you don't want to buy when people are selling, and you don't want to sell when people are buying. At some point, you have to know when are people buying and when are people selling. And RSI is one of those ways you can do that. So I think I should have done that from the criteria, screening criteria point, to show you exactly how I screen and what happens. So I'm just going to reset this FinViz. Then we see what it looks like from the beginning of the screening process. So one moment here, we'll get this sorted out. Then let's go. The last one is price. So I'll do any. Okay. So like I said, you use FinViz to screen, and screening means just sifting out the stocks that are not ready for you to buy and keeping the stocks that are ready for you to buy. So like I said, the first screening criteria is volume, and you can either use current volume or average volume. In essence, you want something that has good average volume, but also for current volume, it means it's what's happening currently. And therefore, if that's a little bit higher, it's a little bit better. So like I said, you want something that's around 500K current volume, or if the market is closed, you use average volume and you use 500K average volume. Now on this list, you get there's like 88 stocks in total that has 500K volume. And then the next thing I said was RSI, which was a relative strength index. And with RSI, you want it to be oversold 30. At that point is where a lot of people who are selling have sold, and a lot of people who are in the market are trying to buy. So the sentiments have shifted from now selling to buying at RSI oversold 30. But if it's RSI overbought 70, it's a lot of people who are buying are now shifting to selling. So if you're looking to sell, you want to do overbought 70 and above, and if you're looking to buy, you want to do oversold, overbought 70 and above to buy, and oversold 30 and below to buy. So you take that oversold 30, and that gives you a point where a lot of people are trying to buy that stock. So if you are a buyer, you want to come in at that point. Now, with that criteria set in, what we want next is price. So depending on your capital, you want to pick a stock price that is able to at least give you around 100 shares. 100 is a relatively okay number. So 100 shares, if you're buying a share that is $10, that is $1,000. Now someone's like, 1,000 is a lot of money. Why that? You can buy 20 shares, that is $10 each. You can buy 50 shares, that is, what's the number there? So 50 shares at $10 each, that's $500. You can buy 30 shares. So depending on how much you have, so if you have $300, that means you'll buy 30 shares that are $10 each. Or you can buy, if you have, say, $500, you can buy you can buy 10 shares that's worth $50 to get 500, or you can buy 50 shares that is worth $5. So depending on how much you have in terms of capital, it will determine the kind of price you are looking for. So you don't want something that is very expensive that will end up buying only 2 shares or 5 shares. But you also don't want something that is so cheap, because there is also this issue of penny stocks, which rise and fall very fast. So you might buy a stock that is $1, but that stock drops to 2 cents, and therefore you've lost like 80% of your capital just like that. So some of these cheaper stocks are very dangerous to buy. That's why I recommend, if you're buy something that is around $10 and above. And now, depending on your capital, if you're looking at $10, you can buy around 20 shares, that is $200, 30 shares, $300, So do that math. That's why a calculator is very necessary for this. Quickly, you can just pull up your calculator, do the math, and move on. Now, with the price, like I said, you want something that is, around $10 to $50, depending on your capital. So when you go to FinViz, there's a price portion there, where a point where you select the price, and you can either do specifically a specific price like $5, $10, $20, or you can choose a range of, say, $10 to $20. Okay. And now this gives you around nine stocks that are between $10 and $20 that have volume over 500K and that are oversold, RSI oversold 30. And then you can use other criterias to now filter out even further. So if you go to the fundamental tab right here, you can say, I want something that, makes profit. So price to earnings ratio is a profit determinant, and you can select something like, I want something that is profitable. So you do that. And now you can see it keeps reducing. Now you only have 4 shares left. So this is the point of screening, that you're taking from a list of thousands upon thousands of shares or stocks, and you're reducing it to a handful that will be now good for you to buy at whatever price it is. So let's take this as our list. Now you take this and you put it on something called a watch list. A watch list is a list of stocks that have met your screening criteria, that then you want to see what is going to happen in the next few hours with these stocks that will compel you to buy them. Or these are the stocks that you want to look further into and see, is it really good to buy these stocks at this time? So screening just helps you reduce the choices to a handful of choices, and then from these choices you can therefore go ahead and pick one or two and make that purchase, and then make your profit eventually. Now, once you've done the screening, the next thing to do is stock analysis, because you want to know, is this good for buying right now? Like, you want to be sure, is this the right time? Is this the right price? And for the most part, you want to do analysis so that you understand what the stock is all about. If you're buying it for long term, you want to know, are they making good profits? Are they making good revenues in terms of sales and revenues? Is their cash flow good? Is their, current ratio good? You don't want something that is losing money and you're buying it long term. Just like our Kenyan market, if you were to say buy Uchumi stock, 5 years ago, thinking you're going to hold Uchumi for the next 5 years, you'll be certainly wrong, because right now Uchumi is, dead. So when you're trying to screen, you're also trying to look at your objective. Are you trying to trade this stock temporarily in a short period of time, or are you trying to invest in this stock for long term? Now, when you're screening, you can put those criteria in to determine if a stock is good for long term or short term. And then now, once you have a list of stocks, the next thing to do is analyze. So like I said, there's two types of analysis you can do on a stock. One of them is the fundamental analysis, where you try and look at the company's performance in terms of their books or their numbers. You want to look at their balance sheets, their cash flow statements, their price to earnings ratio, their sales and revenue, and the likes. So under FinViz, there's this tab of called fundamental. Here is where all those fundamental analysis criteria are. So like stuff like debt to equity, return on equity, you can use this to determine the numbers, the books, are they good or not. So for the most part, people do fundamental analysis when they're trying to invest in a stock for a long term. And the opposite to that is technical analysis. If you're trying to do technical analysis, you are trying to use historical data of that stock to determine future performance of that stock. So on a technical analysis, what you'll do is you'll go and see on a chart how this stock has been performing in the last 1 year, in the last 5 years, in the last 10 years, and say, based on that performance, what's going to happen in the future is going to look like this. Now, most people do technical analysis unless you're doing long-term investing, is when you'll go and do fundamental analysis. So what we'll do next is we'll tackle technical analysis just on a we're just going through it fast enough for the basics. This is not like I'm teaching you everything to know about technical analysis, but just giving you an overview of what technical analysis looks like. So you have your list of stocks. You want to look further into these stocks, and you say, okay, let me look at the first one, which is CLF, Cleveland Cliffs. And you want to know, is this stock good for buying? Through technical analysis, because you've put in some of the fundamental analysis through the screening, and now you want to see technically, is it good or not? And like I said from the beginning of the webinar, is you use a trading view for your analysis, charting and the likes. So charting website, FinViz is a good, not FinViz, TradingView is a good one. So that stock was CLF, which is Cleveland Cliffs. And you want to know, okay, performance-wise, what's happening to this stock? And now you have an ability to choose between the time frames. Let me get rid of some of these things, because for basic chart, it doesn't have all that stuff that was there. So when you're coming to TradingView, it will look something like this. And then here is where you type your symbol, which is a CLF. And it should say here NYC, or you should have an American flag. So if it's a NASDAQ or NYC, it should be at least the first one at the top there. And now you have your stock there. Then you want to see, based on your investment goal, are you investing or are you trading this for short term or long term? Are you investing in it or are you trading it? So how you going to, the time frame you're going to look at depends on how long you want to hold that stock. If you're trading it on a day or within a day, you might want to do a 1 minute chart. But if you're trying to do like long term, you want to do 1 hour, 4 hours, or 1 day going forward. Now we want to see, let's pick the 1 day and see how has this stock been performing for a longer period, not just a few days ago. And if you zoom in and zoom out on this chart, you can see that it's been steadily going up, and then consolidated, and then went up a little bit, but then came down. Now you know where you are. You are at a point of the stock where it has gone down, and chances are, like a lot of stocks do, when they go down, at some point they will start going up, and that's where you want to be. You want to buy when they're down and sell when they're up. Now, based on historical information, we see that at almost the same point back in February, this stock was at that same price. And what happened when it got to that same price? It went up, and using a measuring tool here, we can measure how far or what percentage did it make. And we can see it made around 107% from that price point to the highest it ever went within that time frame. So it took 69 days to get to 107%, and that gives you an idea of what you should be expecting. Now, at the same point, you can still go back again in time and see where it was at the same point and how far up did it go. So if we go back here, back in April of 2021, and you can see on a short term, it went up 39% in 19 days, still kept going up up to 53% in 54 days, and still kept going up to 64% in 117 days. So this is what technical analysis is, that you're trying to see, okay, if it's here, what is the future possibilities and how far can it go in the future? And this just shows you that you could have done probably, you can do something like 39% in 19 days, or you can do 54% in whatever, and you can do almost 65% in 117 days in the future. So as you're trying to analyze this stock, that gives you an idea, okay, if it can do 39% in 19 days, is that a good time frame for you to invest in this thing? And if it can do like here where it did 107 in like 67 days, is that a good investment? To make 100% in 67 days, is that a good investment for you? So that's technical analysis, and part of that also involves trying to figure out, okay, where is it? Is it at a good point? And some of the things you use to determine if it's at a good point is something called indicators. So here on TradingView, there's a tab called indicators, and with indicators, the one we know already of is RSI. RSI, like I said before, is a relative strength index. It shows you where the market sentiments are. Are people trying to buy this stock, or are people trying to sell this stock? So from FinViz, we've seen that we are at RSI 30, and using that RSI indicator on this list from TradingView, we can pick the RSI indicator which is relative strength index, and that comes up here at the bottom of the chart. As you can see, there is something new here, and the RSI is this purple line with a moving average, simple moving average, with in yellow. Now you can notice there's like a purplish region, and there's a regular white region. This is the region of which RSI is measured at. And you can see at the bottom of that purple region is around 30, and at the top is around 70. So when the RSI, which is this purple line, is below 30, that's when you want to buy. And if it's above 70, that's when you want to sell. So that gives you an idea of when to buy and when to sell. You only have to wait for it to go to RSI 30, then you buy. And then you have to go and wait for it to go to RSI 70, and then you sell. Now let's look at a sample point. Somewhere like here, let me get a line. Somewhere like here, that RSI was below 30, which is oversold. And as you can see, from that point going forward, the stock started going up. As the RSI went up, the stock started going up and up and up, and then it got to this point where the RSI is above 70, and it hit a peak. And as you can see, that just shows you that if you had bought here, you could have sold at this point. And you can measure that and see what percentage you would have made. So if you are buying here at RSI 30, and you're selling here at RSI 70, that would have been 30% in 36 days. Okay. Now let's go to the next points where RSI was below 30, like right here, and then when the RSI was above 70, like right here. So as you can see also at this point, RSI was below 30, you could have bought here, and you just wait until it gets to above 70, and you sell there. So let's see how far it had gone with this movement. These would have done 64% in 39 days. So as you can see, just using RSI can give you a good return in terms of your investment. But now this is based on around a month plus waiting time frame. And RSI by itself sometimes is not that accurate, because at some point you can notice that here RSI was above 70, but then back here there was no point, it was below 30. And then over here it still kept being above 70 and kept going back, going even higher than that. So to just gauge when is it the best time to buy and when is the best time to sell, you might want to involve other indicators. And like we said before, volume is one of those criteria you use to determine some of these things, and that's also an indicator on the chart when you're doing technical analysis. So under indicators, you go and look for volume. Volume will also help you to determine whether are people buying or are people selling. Because if there's higher volume, depending on the color of the volume bar, you will notice if people are buying or people are selling. So if you see a huge green bar, let me zoom in for us to see some of these bars. Now, just like up here, I don't know if you guys know candles, but the chart here is made of candles. These are candles right there, the green things you see here. So for those who know, that's straightforward. For those who don't know, we will talk about that on a future webinar or a training session. Now, just like the chart has candles, the volume has bars. You can see here there's like a bar chart. there's bars, green and red. Now, an indicator, volume as an indicator, is when you see huge volume bars, like this green one here, or this red one here, or this green one here, or this pile of big green ones, or this one red one. These are indicators to show you points of interest. So whenever there's a lot of green candles, you know a lot of people are trying to buy there, and whenever there's a lot of red candles, you know a lot of people are trying to sell there. So when you see a series of green candles, green bars in volume, you know a lot of people are buying around that point. And then when you start seeing red is when it gives you an indication that it's about time you start thinking about selling. And this, as you can see here, there's a big red bar, volume bar, and that shows you be cautious, try and close your position right there. But then if you kept holding, you can see now everything starts turning red in volume, and it keeps going red until you get the peak right here of red, and everybody's selling at that point. And that means if, say, you are here and you're trying to figure out when do you want to sell, this would have been a good indicator to show you that, hey, it's been good, it's been green all this time, but it's about time you sell. But if you had waited even longer, this would have shown you that it's a good time to sell before the whole decline. So even if you had to hold this while RSI was above 70, you still would have gotten out at this volume bar. And this was a clear indication that if you keep holding beyond here, it might not look good for you. Okay. Now the same to buying. You want to wait for this big, a series of green bars in volume, and then a big one. Then it will show you that it's about time to buy. So when you see a series of green ones and you see a big one like this one, that shows you it's a point to buy. But then you have to also see where is the RSI and where is the other indicators. So as you can see here, if you combine the volume and the RSI tells you it's already almost too late for you to buy. So this volume here is a false one to use as an indicator. But if you are, let's say, back here, after this series of red volumes, then you start seeing green ones. A good rule of thumb is a bunch of green ones, green volume bars, gives you some sort of confidence to say that a lot of buyers want to buy in. And a bunch of red ones gives you the idea that a lot of sellers want to sell that stock. So when you start seeing continuous green bars in volume like this, it's confidence that people are more inclined to buy than they are to sell. And then when it turns red, people are more inclined to sell than they are to buy. So that's how you can use volume to determine, in combination with something like RSI, to determine a good point of entry and a good point of exit. Then the last indicator I would want to talk about is stochastic. Stochastic also gives you an idea of when is it a good point to buy and when is it a good point to sell. So stochastic is right here, STOCHASTIC, stochastic, not this stochastic RSI, but just stochastic. Now, with stochastic is almost like RSI, you can see it down here, and they kind of correlate. As you can see here, RSI was below 30, and over here, stochastic was also below 30. But with stochastic, there's a blue line and a yellow line. And what that means is you can use those to determine if the trend is changing from a selling to buying. So when yellow is above blue, that's a downward trend. And when blue is above yellow, that's an upward trend. And for you to notice the change, you'll have to wait until you see the blue going above the yellow and you know it's time to buy. And then when the blue goes below the yellow, you know it's a time to sell. Just like here, for example, on this stochastic right here, blue went above yellow. You could have bought around here somewhere. Let me change this to bluish. And then over here it's like an indication of selling, but you might want to hold on to that. And then right here is when it goes above that blue band of the stochastic region, right here when it officially crosses for real, and there's volume there, that gives you like a good idea of a point to sell. So with this, you can see it's not a lot of movement, but at least it can show you an exact entry point and an exact exit point. So this will just have given you like 14%, which is decent for a lot of people who can't make, who are trying to invest. That you can make 14% just like that with 3 indicators and a chart like this, simple as that. So for the basics, this is something you can use and it will help you to make your first trade, to start investing. So with this, you can see that whenever blue crosses the yellow, there's something going on, and whenever blue crosses below, there's something going on. So you can use that in combination with RSI and other things, the volume, and you can play with that to determine your entries and your exits. Now, the reason as to why I say the stochastic will be the last one I'm going to discuss is because it won't pay you anything to have a lot of indicators on your chart, because it then brings in confusion. Because you might want to add more indicators, but at some point it becomes it's a point of depreciating returns when there's too many of them that you can't even see the chart. Okay, so when you're trying to analyze a chart, it doesn't pay you to have more indicators on the chart than to have less of them. So the less is better than more at this point in time. And you might not like using RSI, you might not like using stochastic. I would suggest that you try and learn the other indicators that are there. I know at least a handful that are very good. Something like average true range, ATR, is a very good one. Bollinger Bands is good. Which is the other one? Let me see. Ichimoku Cloud is good. MACD. What is that? MACD. It's not here. Moving averages. A lot of people use moving averages also, but I would say the reason as to why I don't use moving average for the most part is because moving averages are lagging indicators. That they don't predict the future, they just show you the average based on the past performance. So moving averages, they work to a certain extent, but at some point they become pointless. That doesn't mean you shouldn't use them, but it just means know when to use some of these indicators. So moving average is also good. Parabolic SAR is good, and then relative strength index, and which other one? Volume weighted average. Yeah, VWAP, volume weighted average price, is also a good one. So go look into these indicators, see if one or either one of them works best for you. You don't have to use what I use, but all I'm saying is don't use too many of them because it will end up confusing you instead of helping you. So that's just a brief overview of what technical analysis is. More is out there when it comes to what technical analysis is. And because this is a basics class, I wouldn't want to go into further details. Like, I think by now you've noticed it's a little bit complicated. So we want to move on to the next section of, now you've used indicators, you've found, that this stock is good to buy and all that necessary stuff. What we want to go to look at next is what strategies can you use when you're on the stock market. Because just like grocery stores or grocery shopping, you can go buy avocados that will last you a whole week, but we all know avocados are very, very sensitive fruits. You can buy 5 of them today, but 3 will not be good in 2 days. You can consume 2, but then the other 3 will be spoiled. Just like, some fruits, you go buy them and then keep them longer. Like you buy them a few days earlier before they get ready for you to consume them. So the same thing to the stock market. You want to know why am I trading? Why am I investing? And what strategy should I use so that I get the best results out there? Now, when choosing strategies, you can choose based on the time in the market. By that I mean, how long are you going to be in the market? Are you short-term or long-term? Okay, so if you're a short-term investor, you are more of a trader than an investor. So if you're doing 1 day, a few minutes to 1 day, you're more of a day trader at that point. So your strategy would be around day trading. But if you're the kind of person who holds the stock for a few days to a week, you are more of a swing trader. And a swing trader will buy a stock today, wait 2 days or 1 week, and then sell it. But a day trader will buy today and sell before the end of the day. And then if you are the kind who likes to invest, is you're buying it today and you don't care. You hold it for 2 years, you hold it for 5 years. You are investing at that point. Short-term movements don't affect your sentiments about the stock unless it's clear that stock, is clearly going down, and maybe it's time to remedy the whole thing. So when it comes to time in the market, we've talked about day trading, and day trading also has its strategies, because someone who buys and sells in 2 minutes is not the same strategy as someone who buys and sells within the same day. So if you're trading in very short time frames, 2 minutes to 15 minutes, that's something called scalping. All you do is find a stock that is down, like right there. It takes you 5 minutes. You go up to there, you sell, you wait until it shows you another sign to buy. You buy, it takes you another 5 to 10 minutes, you sell. And you keep doing that as the stock goes up and down, up and down. All you're doing is just chopping off few profits here and there. And with scalping, you'll realize that the cost of you doing that trade will be a little bit higher than if you are to buy once and wait until for it to go up, because there's stuff like commission and the likes. So you don't want to do scalping if commission is a factor and other costs that are involved. Now, with day trading also, you could be a momentum trader. You trade on movements. So when there's high volumes like this and that, that's when you come into the market. You want to jump into a moment or a momentum and then ride that. It's like a wave. You jump into that wave, like right here, you jump into this wave, and then when the wave starts to die out, you get out. So that would be beneficial if we did like 1 minute, so that you can see some of these waves in short time frames. So a momentum trader, you come in using momentum indicators and the likes, and when you're coming in for short moments. Whenever there's a volatility is your best friend at that point. So when you're screening, you want something that has higher volatility. So under FinViz, there's a criteria for volatility. right here, volatility. So if you are a momentum trader, you want some sort of volatility, and you want to find something that is more volatile at that point, and you come in and you get it. So you can choose 5%, 3%, or whatever volatility, and then whatever stocks will show stocks that have higher volatilities based on your criteria. Now, that's momentum trading. There are people who do trend following. So just like a trend line in people who've done math, I think you know what a trend is. When the graph, you see a graph and you're told to draw a line that touches all the points, it will look something like that. And then the other one will look something like this. Touches all the points. That's a math thing. Let me use red for this. That's confusing. Green for that. I'll just move these lines a little bit to the side so that they are visible, not confusing with the candles. Now, you can see with the green line, it's more of like an upward movement. Like it comes from down here going up, and with the red line, it comes from here going down. So there are people who just trade based on trends. You come in, you ride that trend going down or going up until when the trend changes. So when you're day trading, you just wait for the trend, and when the trend breaks, you shift your position. So something like here, this is like an upward trend going that way, and something like here is a downward trend going that way. So whenever that trend is broken, that is now the chart is moving an opposite direction. If it was going down, it's now going up, or if it was going up, it's now going down. That's when you stop. You take profit or exit your trade. So day trading has those trading strategies, and there's more. There's more pattern trading. There's a lot out there. People have patterns they follow. They have strategies they use. So you want to be a master of at least one or two, because if that's your method of investing or trading. So some of these methods could be applied in swing trading and also investing. So if you're investing, you know this trend. If this company is just going up and it takes 2 years, you stay in it for 2 years. So trend following can happen either short term or long term. Now, the second way in which you can use to determine your strategy or a method or whatever type of strategy you're going to use when you're investing is based on goals. What is your goal when you're investing? So if your goal is for income or dividend investing, then when you're doing the screening, you also have to screen for dividend stocks. Then when you're coming to trade or to chart or to analyze, you're also looking for how soon is the dividend and how much is the dividend. So based on that goal, which is income or dividend, you can decide that I'm only going to look for stocks that give out dividends. And then if you are the kind that looks for your goal is profit or speculation, you are more of a day trader. So you want to make profit in a short term. That's your goal. You might want to be a day trader at that point, and your strategy will be based on day trading strategies. You just want to make profit. Then there are people who want to do long-term investing, so for growth purposes and something like preservation of capital. What you do is you analyze the stock on a long time frames, like 1 day or 1 week, and then you're going to hold this stock for a long time for that slow growth, 15, 20, 30% a year, and you're comfortable with that because you're going to hold this for 5 years or whatever. So based on your goal whether it's passive income or dividend investing or profit, short-term profits or growth, your strategy will also be revolving around those goals. So if you are more growth oriented, you'll be more of an investor, so you'll use investing strategies. But if you're more profit oriented, you will be more of a day trader, so you'll be using day trading strategies. And then the last one is based on frequency. How often do you want to be buying and selling? Okay, which still comes back to that day trading and investing long term kind of thing. But this is more like, yes, you're buying and selling, but in what frequency? If it's in short frequencies, then that means you're buying and selling almost within the same day, or you're buying and selling within the same week. You are more considered of an active trader or an active investor. And then if you hold it for a long term without making the trades, that is, you buy and you hold it for 1 year before you sell, you're more of like a passive investor. So active investors are more of day traders, and passive investors are more of investors, long-term investors. So if you're an active investor, your investing strategies will be based around the day trading strategies. But if you're a passive investor, your investing strategy will be based on long-term investing and stuff like dividend investing and growth-oriented investing. So those are some of the strategies you can employ when you are doing your investments. So just to recap what we've done, we've gone through what you need to get started with investing, stock investing, which is you can use a phone or a laptop. You can have a calculator as a bonus. Then on top of that, you need a broker, and with the broker comes trading platforms. And with trading platforms, you might also want to use other sites for stuff like chatting with TradingView and screening with FinViz. And then after that, you want to do the screening, which you go to the FinViz and you do your screening. After that, when you've done your screening based on stuff like volume, RSI, price, price to earnings ratio, dividend, and whatever you're trying to do, you will be left with a few stocks that you'll put on your watch list, and then from there you go do analysis on these stocks on your watch list. And then the next thing you will be doing when you are doing the analysis, you'll either be doing fundamental analysis on those stocks, or you'll be doing technical analysis on those stocks. And we've talked about what fundamental is and what technical is, but more so we've handled a lot of technical. And with technical, we've talked about how to use indicators and chart. And then lastly, we've talked about your strategy. What is your goal? What is your aim? What is your purpose of trade investing? Are you doing for short term? Are you doing for long term? So all that is what we've discussed today. And I think that concludes the part of these basics. So what is left is probably how to make the trades, and I think I have a video of that on YouTube on how to trade on interactive brokers.